Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best in macro and markets thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. It's quite amazing how an obscure discussion board on the social media platform Reddit has suddenly entered the headlines of financial media. Suddenly, smart hedge funds that were shorting companies like GameStop have been squeezed by the Reddit retail investing rebels. Markets are on the ropes, but in a piece I just published, I argue that this may not be the big bubble bursting moment that many have been looking for. So look out for that piece. And continuing on this contrarian theme, credit guru John Tierney has written on the surprisingly low default rate in the US and what this means for credit. We also have a great piece on carbon pricing and climate change, and another on how to trade a US-China trade war. All of these pieces are featured on the Macro Hive site. So if you're not already a member of Macro Hive, I'd urge you to sign up at macrohive.com. Your first month is free, and then it's only the cost of a few weekly cappuccinos. And many call Macro Hive the hidden gem for investors, so it's well worth it. Once again, sign up at macrohive.com. On to our guest for today, John Turek. He's the author of the Cheap Convexity blog, and he always has great insights on Fed policy, rates markets, and the dollar. He also tells me he's a New York Jets fan. I had to Google them, and I found that the Jets are an American football team. And when I say football, I mean the American version, where you use your hand rather than your foot to play football. And my internet search found that they seem to be a particularly unsuccessful team. So I can see that John must be a very loyal fan or very stubborn. On the latter, I wonder if he's been selling JGBs for the last 10 to 20 years. And hopefully I'll find out in my conversation. So on to my chat with John. Okay, welcome, John, to our podcast show.
Thanks so much for having me.
Yeah, I have to say, I didn't know much about you until very recently. I came across some of your work and I was really impressed by the sophistication of your analysis. And only through our conversations have I realized how young you are, which I think goes to kind of show how smart you are. So it's great to have you on. And that also kind of begs the question of how did you get to where you are now? How did you end up looking at the markets the way you're looking at markets now? I mean, what's your origin story, so to speak?
Yeah, so I guess I always had a little bit of an itch for markets, even going back to high school. But kind of where I am now is that I was at an international school in Israel for university. And for the 2 years prior, I worked at a fairly prominent New York macro fund. And then kind of also I've been running this Cheap Convexity blog that allowed me to engage with a lot of very interesting market participants. And that's kind of led the way to me starting my own research endeavor, also by continuing the Cheap Convexity blog on Substack and also a more weekly institutional product that caters more to hedge funds.
Okay, great. Just out of interest, you tend to focus more on rates and FX and monetary policy and so on. Why did you focus on that rather than say equities, which some people kind of go down the equities path?
Yeah, so I kind of came at markets more from an economic perspective. Actually, my senior year of high school, I competed in the Fed Challenge, which is like a high school competition that takes place at the Federal Reserve in New York. So more of my introduction was from the policy side and economic side. And I guess I found that also the market effects and the intersectionality of it all was really interesting. So I guess, as opposed to a lot of people that come into markets, I started more on the econ side as a primary interest, and going through Fed speeches and reading Keynes and stuff like that was kind of more my origination.
Yeah, okay, that's great to know. Let's kind of jump into some of your kind of views on things. I guess we can perhaps start with the Fed and their change of framework that they introduced last year. It was kind of 1 or 2 years in the making, but it was, and it is, quite a fundamental change. How do you view that change, and how did you view some of the players behind it in terms of their contribution to it, whether it's Brainard or Clarida or Powell even?
Yeah, so I think it, as you say, it is a very fundamental change. And I think that few interesting things, but one of them is that it really kind of started pre-COVID. In 2019, we had an economy that was pretty close to full employment in the United States. We had inflation that was stubbornly below the 2% goal of the Fed, but within the realm of price stability that's acceptable. And the Fed started cutting rates and ended up cutting rates 3 times in 2019. And I think that, and with what the Fed review and the Fed macro framework kind of changed, was really adjusting to a structurally low R-star world, the neutral rate of interest. And that kind of laid the groundwork for a lot of their 2020 moves. And I think that what the Jackson Hole meeting last year kind of showed is that the Fed's has a new reaction function entirely in how it responds to upside risks. And there's an immense asymmetry in their view in terms of the distribution of outcomes, and they heavily favor downside risks. As in, now the Fed is saying that, okay, if anything were bad to happen, we would be on that like a hawk, and we'd be very preemptive about it. But on the flip side is that with good things happening, as we've heard even yesterday from Jay Powell, and the last few weeks, the outlook for this year and next year has improved on the back of vaccine rollout, et cetera, that they will only respond to realized outcomes, not expected ones. And I think that kind of framework view is how they're really going to attack, monetary policy making going forward, is that the reaction function on the downside is going to be very oriented to preventing left tail risk. And on the flip side, on the upside, is to accentuate right tail positive outcomes by basically letting policy procyclically expand for them, even if that means that things will overshoot.
Yeah, understood. And that implies lower R star, which is, I guess the neutral long-term rate. I mean, what do you think their justification is for a lower R star?
Well, I think that even going back to 2019, and, in the academic community, it was quite perplexing that, 3.7% unemployment rate would have pretty much no impact on inflation. And I think it's kind of become, there was a really fantastic paper at Jackson Hole in 2019, kind of looking at like all the global interlinkages between, how our star, in places like Europe and Japan, et cetera, affect even the US rate. And I think the combination of the fact that generally the neutral rate of interest is very low on the back of, all these structural dynamics that everyone's talked about, whether technology, globalization, et cetera, and the fact that the Phillips curve, the trade-off between unemployment and inflation has become so flat that the Fed basically kind of had to entertain this idea that, it is a different R star world. And what that means for policy is that, especially as to ease policy, you have to basically be within the neutral rate, so that the path to accommodation is a little harder, is that the Fed basically has to, and central banks around the world have to remain dovish for longer. And I think that's a big story for the Fed now, especially, and we'll get into, policy through the dollar, et cetera, is that there is this big global component to the neutral rate of interest setting in the United States. And that was something they probably underestimated in 2018, where the Fed was hiking on the back of a 3% growth rate in the US, while European PMIs were starting to, go into the 40s. And I think that the Fed is post 2019 taken a much more global view of how their policy interacts and the rest of the world's policy interacts with the domestic policy setting.
And what do you think about the specific framework they've adopted, average inflation targeting, or, some people have called it temporary price level targeting. They could have chosen lots of different ways of doing this, but they've decided on this, and they've got a maximum employment component thrown into the mix as well. Does this particular expression, is that important, or is it just more what you said earlier, just they're going to react more to bad news than to good news?
Yeah, I think that the implementation does matter a lot, because a lot of this policy now will basically function through forward guidance. And forward guidance is basically amplified by a strong policy backdrop. And, we've seen this with the ECB kind of 3 or 4 years ago, when they were entertaining the idea of, slowing QE, or even, beginning to normalize policy, is that, a large part of policy at these very low interest rates is forward guidance and kind of anchoring the slope of the yield curve, et cetera. So I think the implementation, especially if it's average inflation targeting or temporary price level targeting, whatever the nomenclature, it's a bit of a shift between the two, but it's basically a way for them to kind of not allow these circuit breaker effects that have happened in the past to change the scope for the economy. I mean, one of the things they definitely learned from the 2010 to 2020 decade was that a lot of the net effects of the market basically preempting their policy response curtailed a lot of the moves they wanted to see in their infancy. And we saw this in 2013 with the taper tantrum, is where the economy started to knock into what was then the Evans rule of a 6.5% unemployment rate. The market was able to discount Fed reaction function from there via tapering of asset purchases. Tapering of asset purchases mean that rate hikes are sooner than later. And that basically was all priced in a very short time horizon, and it curtailed a lot of the progress that was going on by these financial feedback loops of higher rates, higher dollar, et cetera. So I think the Fed now is very focused on basically laying the groundwork through, some of these more academic jargons that basically don't allow these circuit breakers to take place and allow the recovery to basically fasten.
Yeah, I see. One of the things I've kind of found interesting is that when you listen to speeches by various Fed members, Clarida, Brainard, Bostock, just all the assortment of characters that you have, they all seem to have their own way of interpreting this shift in framework. They don't all seem to be singing from the same hymn sheet. I mean, what's your interpretation of that?
Yeah, I mean, it's been very interesting to start the year even. We've seen this kind of with, Bostic talking about, well, the upside looks a little better. Maybe we can change policy later this year. I think going forward will be that the board, especially the leadership, which has been fairly consistent. I mean, if we look at Clarida, Brainard, and Powell, I think they've been pretty clear in terms of that this is the new reaction function. We're going to enforce it. And I think it's been laid out very well in Brainard's speeches, kind of all these transition periods where, okay, we responded to a shock. Now, how do we go from stabilization to accommodation? And it's very much laid the groundwork to basically let the economy pro-cyclically ease for them, because via them not responding and the economy improving is in that there's this pro-cyclical expansion of policy that they want to happen to basically make this a different recovery than 2009-10. And in terms of the messaging, I think it's, it will become important for them to basically proactively also expand with it, because as regional bank presidents such as Kaplan and Bostic have noted that, as the outlook gets to a certain level of, relative robustness, is that the bar for them to reinforce their reaction function kind of goes higher. And I think that's one of the things they learned so far in January is that, well, it's easy to say in 2023, we don't see a dot, we see the dots unchanged and rates will be unchanged when, 10-year break-evens are 1.5%. But when 10-year break-evens are at 2, the market's going to look for more to kind of reaffirm and recommit to there. So I think that the Bostic miscommunication was actually ended up being good for them in that we saw new things such as Clarida saying it would take at least a year of 2% inflation before they would contemplate liftoff. And the combination of this repricing on the back of the Georgia elections and the Bostic, call it miscommunication, or at least out of sync with the rest of the key FOMC, kind of allowed them to basically be more aware that, the market's not going to let them have this, luxury of just saying, okay, we set policy and forget it.
Yeah. And I've seen in some of your research that you have one or two ways that you like to express a market's view of this new framework, through the curve. I mean, can you talk a bit more about that? Like, how would this map onto rates markets then?
Sure. I coined it kind of cheekily, and I called the Brainard Steepener. And where that comes from is basically this idea that Governor Brainard in a speech in July and in September basically has been talking about this transition of policy that in the recovery period, the Fed can actually become easier by doing nothing. And I think it's a pretty powerful force. And we've seen that in real yields, probably from the summer of last year on, that have become increasingly negative. And I think basically what this reaction function does in a market sense is that markets pro-cyclically expand on the back of this recovery, et cetera, is that in the belly of the market, real yields continue to fall. Because basically, say 5-year yields the nominal component can't really respond on the back of the Fed saying we're not hiking ever and on the back of massive asset purchases. But the inflation component is rising on the back of an expected recovery. So real yields continue to fall. And then in the back end, you can effectively be short the nominal, because if the recovery is expected to continue and real yields reach a rate of extreme level of accommodation that can really fasten this recovery, then the term premium element of the trade has to kick in somewhere. And the Fed really wants it to be in the back end, so it doesn't upset kind of the financial conditions they've laid in. So basically, you can kind of take the Fed's goals and say that, they want a term premium response. They just don't want it in the belly. And you can kind of play those two things against each other by basically 5s, 30s go higher, but it's really the real part. So it's really the real yield part of 5s and the nominal part of 30s.
Yeah, I like that expression actually, because if you look at, say, 5s, 30s, they have broadly been steepening over the past year or two, but it stopped steepening over the last, say, 6 months, after maybe from July onwards. But I suppose if you switch the 5-year to real, then I suppose 5s, 30s, 5s real, 30s nominals have continued to steepen because 5-year real yields just carry on on going down, carries on going down. So you kind of caught that. So I can see the logic in that. And maybe that's quite a neat way of playing as kind of a core trade to hold on to, for a year or 2 years even, because this should do quite well, even if you get a recovery. I suppose the question is, how would the trade do if you had a taper tantrum?
Right. But the question is in a taper tantrum, would there be enough of a real response in the belly that would offset your gains from the nominal component? And I'm not sure. I think that the nominal part in the back end could keep up, because I still think in a butterfly, the tens part of the curve would probably lead in a tantrum. But I think the fives is probably too close policy rate for it to really contribute meaningfully. But I think that in terms of a taper tantrum, I've kind of been on the camp that it's much more unlikely and less inevitable than people think. I mean, I think that before this week and maybe going into last week, we had a Bill Dudley article kind of sensing that there's no way the Fed can avoid a taper tantrum. And I don't think that's entirely true, because I think that QE going forward will be much more about its linkages to the policy rate and the forward guidance component that it basically reinforces. So I think, one of the things that's got lost in tantrums of the past, especially in the 2013 one, is the Fed kind of lost control because there was a response basically in the red and green Eurodollars that was commensurate with what was going on in the back end of the bond market. As the market took the fact that the Fed was going to taper as a sense that the Fed will then soon raise rate. And I think that it'll be a big focus of this FOMC to kind of decompress that correlation or connection.
Yeah, sort of separate the two from each other.
Exactly. And breaking those linkages. And we've seen this with varying success in other central banks. I mean, we saw the ECB in 2017-18, where Benoit Poirier was, out writing about how asset purchases are most important in a recovery on the forward guidance sense, is that they don't let the market price in rate normalization. And I think that's going to be more of the theme going forward. And, whether the Fed can recalibrate off 120 billion a month, that will be, an interesting question. I don't know if it's one for this year, but I think as long as they can convince the market that recalibration doesn't change the path forward interest rates, at least then that can kind of solve itself.
Yeah. I also think, if you go back to 2013, a lot of things was just new. The Fed was just dealing with how to wind down their QE program, which was a novelty for them. The way Bernanke first talked about the taper tantrum was an accident anyway, in terms of the way he let it slip in kind of a clunky sort of way. And we've had a lot of time and a lot of research since then to kind of understand how to avoid such a thing. Now, you mentioned the ECB. I mean, how do you see policy by the ECB and the BOJ? Because obviously they also, have their own ways of doing things, and they seem more trapped in this kind of low forever, QE forever, much more so than the US. How do you view them?
Yeah, I mean, I think it's a very interesting dynamic for them, and that the ECB and BOJ have kind of become a lot more passive outside of crises, because basically outside of dealing with a March situation in terms of, European fragmentation or liquidity risks, there's not much marginal easing that, the BOJ or ECB seemingly can add. I mean, we've seen that kind of in the past where, okay, they could expand their asset purchases and, that does a lot for bunds, but it doesn't, in terms of financial conditions more broadly, it doesn't change that much. And I think really the interesting thing will be to what extent the BOJ and ECB kind of accept themselves as more passive players, because one of the things that could be different this time in terms of the recovery is if the ECB says, okay, the euro's at 120, the euro's at 125, the euro's even at 130, that's okay, because the spillovers of dollar weakness in terms of global trade are kind of offsetting that and allowing our manufacturing sector, et cetera, to expand for us. And I think that's kind of one of the interesting things going forward in terms of this recovery, is that will central banks around the world, who have usually been very protective of currency levels to protect their export manufacturing sectors, will they be more allowed to, kind of let dollar weakness permeate and have all those positive spillovers that dollar weakness is shown to have in terms of, trade, credit, et cetera. So I think, we've had rumblings this week out of the ECB that they're not so comfortable with the level of pricing in terms of rate cuts. And we've seen kind of a bit of a push to get the euro at 120 is not the greatest thing in the world. But I'm not sure that, maybe they can get a little more priced in the Euribor curve if possible. But I really don't think that the ECB is looking to upset the apple cart in terms of the dollar move. And I think that especially post this sort of shock, the pass-throughs are very different in terms of the exchange rate. And I think the ECB is more worried about kind of the path for euro appreciation than the destination. And I think, it's much more about, is it orderly? It's not it's not a sharp financial conditions tightener, but it's kind of this gradual euro dollar higher situation that allows the European economy to benefit from the positive externalities of a weaker dollar.
And so now that we are talking about currencies, is there a broader implication of Fed's policy and this Brainard steepener? You kind of allude to dollar weakness. Does it follow that the dollar should be weaker in this environment, or is it more nuanced?
It's both. I'll start with the kind of, in terms of the Brainard steepener, I think at its fundamental level, it is a dollar weakener trade, because the feedback loop in which it's working through is that the Fed is able to generate lower real yields, which has pressure on the currency. The dollar goes down, which brings up things like export-oriented economies, commodities, et cetera, which basically, because nominal yields are capped, real yields go even more negative because the inflation component is pricing in the dollar out aspect. And you basically have this virtuous cycle between real yields and the dollar. Now, that was definitely taking place kind of Q3, Q4 last year, and it's changed a little bit now. And I think the change is really the Georgia elections. And I think the reason that's changed now is that the market, especially in real yields, is saying that there's a level where we're going to have a bifurcation in terms of the response in the curve, where, okay, it's the Fed's reaction function is what it is. We accept that. And if the economy is to, improve, the real yields will continue to fall, especially in the 5-year component. But now we're starting to get to levels of accommodation and pricing in this more fiscal permanence that the term premium element is kind of offsetting it in the back end. And that for the dollar kind of means, and this will also be very especially relevant to precious metals, is that the TIPS curve is not moving in unison anymore, is where 5-year yields can continue to come lower, but 10s and 30s can, if not drift higher, stabilize and don't want to go any lower, because the more they price it in, the more term premium response they have and nominals react. So we've kind of had now post this acceptance that we're going to have probably another $1 trillion plus US fiscal bill, and US fiscal is going to become like the Fed, less counter-cyclical and much more, accentuating good outcomes, et cetera, is that we probably for the first time in a while now, the dollar consequences are you can't blindly be short them, as that kind of was the feeling in Q3, Q4 last year. And because there is this rates element to, well, the zero lower bound premium is kind of coming out, where we basically had in Q3, Q4 of last year is like, what if we all go Japanese type pricing dynamic? And now there's a lot of pressure on the dollar in the space of all these outcomes. And now we're starting to transition into, there are a few that it may not be in 3 years, but it may be in 5 years that are going to get off the lower bound. And there are those who won't. And that relative dynamic will start to matter again in FX, I think, and it'll less be, just about beta, where you could have dollar Swissy selling off the same way that Aussie dollar was rallying, even though those relative dynamics should be different relative to the growth environment. And I think those kind of things will change, and currencies that are more risk friendly versus those that are traditionally more defensive.
And so the risk-friendly ones would be in G10 would be things like the Aussie, Kiwi, Canada, maybe the Scandies, and then EM in general, I suppose.
Yeah, I mean, I think in EM I actually think that it will be more favorable to some of the G10 risk-on currencies. I think that EM will become a little bit more bifurcated because this dynamic kind of upsets the apple cart in a lot of, some deficit EMs like Brazil, even South Africa to some extent, where this, distributional change in terms of, well, even if it's 5 or 10 years, whatever it is, the Fed's not going to be at zero forever. Well, you have a harder time pricing, Brazilian interest rates at 2. So kind of those dynamics also then kind of create these frictions between a central bank that is not really in the mood to hike, which we've seen in Brazil, but is kind of being forced into it. So those will have, at least in FX terms, I think will kind of make it differentiated between places like Indonesia versus Brazil, stuff like that. And then I think the other place where this, this could manifest is it's very much in precious metals. And, kind of the summer trade of gold and silver last year was that I did a chart in one of my recent notes is that the TIPS curve was moving in unison. And that was really the juice that gold needed, where we had this real yield correlation with precious metals. And in theory, that's still happening. And all the dynamics that gold were rallying on in terms of more fiscal and a Fed that's passive and basically allowing these sort of overshoots to happen is still in theory going to happen. The question is that the market response has changed to what it was in July. And I think that kind of makes it much more neutral, kind of those things in terms of gold and silver.
Yep, understood. Yeah. Now, many people in the market focus a lot on the Fed balance sheet, its composition, its size, it's too big. There's the Fed sort of stuffing excess reserves in the system too much, and that will lead to kind of transmission issues in the broader economy. So there's kind of technical side of it. There's also just philosophical things about the size of the balance sheet, how that's distorting markets. How do you think about the balance sheet and kind of the quantity side of policy?
Yeah, no, I think it's a great question and one that's especially relevant now. I mean, we basically do have a little bit of overkill in reserves right now where we've, excess reserves have ballooned and, we're kind of past the point of running, an ample reserve system. And with the Fed kind of on this path of 120 billion a month, there's definitely this kind of feeling that there's almost too much liquidity. And we've seen that in, the front end of the curve and things like for OIS going lower, and especially in overnight repo rates, et cetera. And I think that that's maybe where the policy recalibration can come. I mean, I'm sure there will be first more regulatory elements that deal with this. Yeah, I'm sure in terms of SLR ratios and kind of extending that moratorium, which I think ends in March, if I'm not mistaken, and kind of allowing banks to digest these reserves, I think will be critical. But I think that this dynamic will speak to that the Fed wants to be in this QE until our goals are met, not until we think our goals will be met. And that can still happen, even if it's not at 120 billion a month. And when the Fed kind of gets to that discussion, maybe it's towards the end of this year, I think that QE at this point is becoming its marginal impact is on the rate distribution in terms of not allowing the market to price in height. And I think the Fed is cognizant of that. So its calibration can be changed. Going forward, the question is can they communicate it effectively?
Yeah. And I guess if you look at the BOJ, where they have yield curve control and kind of a quantity target as well, that you find that actually the quantity side isn't that important in the end. I mean, they can dramatically reduce JGB purchases and the yield curve remains controlled. And obviously you can't target both price and quantity. It doesn't kind of make sense, but they've kind of somehow tried to dance around that all.
Well, I think also with these, I think that one of the themes, especially as central bank dominance was the key of the 2010 to 2020 decade, was that a lot of these perceived technical hiccups become less scary when they actually happen. I think outside of really the repo thing of September 19, and even including it to some extent, is that these are constraints that once they begin to matter, they're easily dealt with. I wouldn't want to overemphasize the easy part, but it seems that in terms of the plumbing and in terms of liquidity, is that the Fed is able to move it around where it needs to go. I mean, I think that the ultimate test of this was in March of last year. I mean, I was kind of getting worried that the dollar swap program was looking much more 2009-like than it needed to be in 2020 because the end participant was different. In 2009, it was about getting liquidity down the channels to European banks. And now that's easy because European banks have a counterpart at the ECB. In 2020, getting it to Taiwanese life insurance companies and Japanese life insurance companies who have an intermediary between them and the BOJ or, the CBC or the BOK in Korea, much more difficult. And the Fed was able to, basically pass through that liquidity on, having, good counterparties in terms of the central banks who were cognizant of where the issues and where the vulnerabilities were. But, I think that was a real test case too, in terms of these plumbing related concerns that central banks are really all over it.
Yeah, understood. Now, if I kind of listen to what we've talked or listen to what you've said and what we've been discussing, a big part of this is that real yields will stay low more towards the front end of the curve, say the 0 to 5 year. So what would we need to see for that to change, for 5-year real yields to shoot higher? Because that will kind of lead to quite dramatic consequences because everything seems to be geared towards keeping that very, very low. I mean, what types of things would you need to see for 5-year real yields to have a tantrum, so to speak?
Yeah. I mean, I think an interesting test case will be coming up in this summer where, inflationary pressures will begin to build a little. And that's already kind of been preemptively dealt with in the sense that policymakers have already said that they'll be transitory, they're supply side based, or that there's pent up demand. And basically every excuse has already been given for why they won't respond to inflationary pressures. But the question is how sticky kind of will these prints be? And if you kind of get into Q4 and these prints are still a little sticky on the upside, and it's obviously there'll be a very different dynamic than it has been in EM, but we've seen, EM central banks talking about how even outside of supply side concerns that inflation has been stickier on the upside, is that if those factors, the supply side constraints, the pent up demand, increased fiscal spending, all kind of lead to, these things being less transitory. And if the market right now is under the assumption that they will be transitory, and quite rightly, probably, I think that those things were to persist and show signs of being a bit more durable, then the market would have to, look into, 2022 could be a year of 2% for the whole year. And then 2023, the Fed has something to do.
Okay, yeah. I mean, do you think we could get much term premium added to, say, up to 5 years or not? Or is that just really unlikely?
I think it's unlikely because the catalyst for a real term premium response is this extreme accommodation in terms of both fiscal and monetary. And it's basically a kind of a knock-in almost, is that they have to overdo it for enough time that, in the 7, 10, 15-year part that, you can kind of get that term premium reaction. I think it would be very hard for, us to materially change our nominal GDP expectation in terms of the range in the shorter term.
Yeah, no, understood. That makes sense. And do you have a view on broader risk markets, on equities? Because obviously many people are saying equities are expensive, yet other people say because yields are so low, that justifies these valuations. So yield adjusted or using the Fed model, equities are not so expensive. Do you have a take on that?
Yeah. I mean, it's something I've been thinking about a lot, especially in the context of, some of the craziness we've been seeing this week with the retail bros and the Wall Street bets. But I think that the Fed has been noting that they're less worried about froth in equity markets because equity risk premium is very high. And I do think that is a stark contrast between the 1999 tech bubble, is where you kind of had risk-free rates that were high-ish and you had equity risk premium that was very low. And you've kind of flipped that dynamic this time. And I think that will matter in terms of macro context. And then the other thing I think is that we've had this distributional change where policy is immensely focused on cutting off left tails, whether that's the Fed in terms of liquidity events or that's the fiscal authorities in terms of providing the necessary support to kind of create this bridge to past COVID, et cetera, is that it becomes very hard for the market as a collective kind of move lower because you basically have these rotations. And these rotations can kind of feed on themselves as long as the market is comfortable and not pricing such a left tail risk. And we've seen that even in the last few months where post-vaccine news, we have this move out of tech more into cyclically related assets. And then maybe going forward will be as we have, distribution issues in terms of the vaccine, we have, variant risk in terms of the virus, is that the market basically rotates back to tech. Now that will create, different levels and relative moves within the index. But I think at the index level, that could actually lead to some relative robustness because basically in a curtailed left tail world, the authorities have basically turned the NASDAQ into the 10-year note. And in terms of looking for safety, the trade goes from I move more into cyclicals. Something upsets the cyclical backdrop. I kind of go back into tech because if these virus mutations were to, let's say, offset vaccine success or the vaccine distribution is so poor, that just kind of means we have an economy more like 2020, which is that there's a lot of excess savings, there's household balance sheets are relatively robust, and you kind of go back to this stay-at-home trade, and that will have negative ramifications for a lot of cyclical assets. But at the index level, it's a relatively healthy dynamic that the market can kind of rotate within itself relative to how the economic recovery unfolds.
Yeah. And do you have any views on Euro area rates markets or Japanese rates markets? Because they seem a lot more dull compared to US markets. I mean, are there any interesting trades there that you're thinking of?
Yeah, I mean, I think that, Japan is an interesting one. I thought that, in the middle of last year, it would be interesting that kind of Japanese back end would kind of lead this because, they've had this geared response to wanting a steepening yield curve as opposed to a lot of other central banks. Now, whether that trade can continue, I'm not sure because there are a lot of these FX hedging dynamics that kind of make it more advantageous now, for the Japanese to repatriate into, back in JGBs. So I think that trade's probably exhausted, but I did think that was the right way to play kind of this recovery in terms of, the first mover being the Japanese backend, because that would be the only central bank that kind of wanted it. So I thought that was interesting. But now in terms of Europe, I think one of the things to watch will be, one of the dynamics that we can't really have, or the market has proven that it can't really deal with, is this divergence trade where, the market price is in that US will get back to its 2019 levels of economic activity, plus all this, additional robust fiscal, while Europe kind of can't figure out its vaccine distribution. Next gen EU disbursements are slow, and, the fiscal response is insufficient. And that would kind of manifest itself where, the belly of the US is selling off, and, back end bonds and books will like kind of just grinds higher, stays flat. And that's not a good environment for, things like the euro, et cetera. But I do think that it will be different this time, and not in terms of, Europe maybe kind of matching the US in terms of its, fiscal path or potential growth. I mean, I think it's still much more likely that, we'll have a pretty wide gap between where US growth is at the end of this year and where Europe growth is at the end of this year. But the thing I think that is different, as opposed to divergence trades of the past, is that they're both headed in the same direction, and European countercyclical policy is real this time, in the sense that we've had these basically a lost quarter in Q1, but it has been met by increased measures from Germany, France, et cetera. And the counter-cyclical side is not that. Kind of in 2018, it was like, okay, German PMIs were 45, and German finance ministry is saying we still want to run a budget surplus for this year. And I think that kind of dynamic is over, even if it doesn't mean that European growth is going to be 5 or 6% this year, while the US it will be.
Yeah. No, that's great. Okay, I think we've covered a lot of ground, and I think it's been really sort of interesting conversation. I do like to end my conversations with some more personal questions. And one that's always very close to my heart, and I ask everybody, is how do you manage your information flow and your news flow and research flow? Because it's quite easy to be overwhelmed. I see you on Twitter often as well, so I imagine that is quite distracting. So what's your strategy around that?
Yeah, so I mean, I think Twitter is both distracting and unbelievable, in the sense that it's probably information I wouldn't find elsewhere or have access to in such an easy way, but it's also overwhelming, especially when there's a lot of noise going on like this week. I think that I try to kind of break down the day in terms of that, I kind of spend the morning first kind of catching up in terms of news, which Twitter is useful for, but it's, more so in terms of kind of going through the relevant economic data, any central banks that were overnight, kind of going through what they had to say, and then kind of, forming what happened, what's happening, data, et cetera. And then kind of the afternoon is much more focused on writing and thinking without kind of the Bloomberg, Twitter stuff going on. And that's usually kind of how I structure it. I mean, I try to read more books than sell side stuff. I think that, my friend James Aiken was always pushing that, is always read more. So I definitely try. But yeah, I think it's, kind of, I like to start with going through the data, central banks, communication, et cetera, especially speeches, which can be pretty time consuming. But I think understanding the policy backdrop is so important. And then, talking to people about it, and then kind of using, afternoon later in the day to think what it all means.
Okay, great. And you mentioned reading books. Are there any particular books that have really influenced you in your work or even in your personal life?
Yeah, I mean, I think one that even came out this year, which was amazing. Well, I guess last year now, which was the Trade Wars or Class Wars by Michael Klein and Michael Pettis. I thought that was, amazing, and definitely kind of getting my hands on kind of what are the motivating inertial factors that drive a lot of these policy decisions. It's extremely interesting. I say on the market side, the usuals have been very influential in terms of Market Wizards, More Money Than God. That was an amazing one in terms of kind of getting into, it did make you feel like you were, watching an hour documentary on, all these amazing traders. I mean, that book is amazing. Yeah, those are good books. Yeah, well, Michael Pettis, I've read that book. I agree, is very good. We also had him as a podcast guest last year as well, and he was great to have as a podcast guest. His Twitter account is also very good to follow as well, to follow China. So that's excellent. And if people wanted to follow your work, what's the best way they can do that? Yeah, so I'm on Twitter, at jturek18. I also have a Substack, the Cheap Convexity blog, and if anyone wants to reach out, it's john@jstadvisors.com.
Great. And I'll add those to our show notes so people can get to that quite easily. So on that, I'd just like to thank you. It was an excellent conversation and good luck in these markets.
Thank you. You too. Thanks for having me.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a member or subscriber to our research at macrohive.com. We'll be back soon, so tune in then.